Hello and welcome, everyone. I'm Julia Mishi, Senior Business Development Specialist for Aging Services with CARF International. I'm pleased to moderate today's session, so let's get started. I'll quickly introduce presenters for today's discussion, provide an overview of the learning objectives, and share some information about CARF and accreditation for senior living providers. Next slide, please. Here you'll see our presenters for today are Tommy Brewer, Managing Director, Ziegler Investment Banking, Pat Heavens, Audit Partner, Baker Tilly, and Anne O'Malley, Chief Financial Officer, Kendall at Oberlin. Each of our presenters today will provide a brief introduction at the beginning of their presentation. Next slide. Our learning objectives for today's webinar are first to explore some of the financial trends based on 2022 fiscal year-end data and to take a look at what these trends reveal. We will share information to help you gain an understanding of how to utilize the top financial ratios for strategic decision making. And last, we will highlight best practices for developing budgets and demonstrating financial stability based on specific benchmarks. Next slide. We are embarking on a third decade of the Ratio Trends publication with the 2023 edition. The publication provides financial benchmarks and trend data for 17 ratios. Profitability, liquidity, and capital structure ratios are presented in a comparative format for single and multi-site organizations by contract type and quartile rankings. The organizations included in the report are not-for-profit and US-based life plan communities, and the publication is a joint project of CARF, Ziegler, and Baker Tilly. Next slide. For those not familiar with CARF International, we are an independent, not-for-profit, worldwide accreditor of health and human services. CARF originally, the Commission on Accreditation of Rehabilitation Facilities, has its roots in medical rehabilitation, though our focus has broadened over the years to include accreditation services in the areas of aging services, behavioral health, child and youth services, employment and community services, as well as medical and vision rehabilitation and opioid treatment programs. CARF standards provide a comprehensive quality framework for person-centered care and services. We have over 1,500 surveyors supporting our peer-based accreditation process, and CARF accredits approximately 8,000 providers internationally. Aging service accredited providers are located in the United States, Canada, China, Ireland, and the United Arab Emirates. Next slide. It's important to recognize that for the majority of senior living providers, accreditation is a choice and not a mandate. And therefore, CARF routinely asks organizations that choose to go through the rigors of accreditation to share why they pursue the process. And these here on the slide are consistently the top 5 answers provided. Providers share with us that they have a deeply held belief in the value of the process, and accreditation standards help them to establish and maintain a quality framework that further distinguishes them in their communities. Providers also note the relevance of the standards as one of the top 5 reasons that they continue to pursue accreditation. Next slide. CARF standards are updated annually, and I'd like to just take a moment to recognize the work of the CARF Financial Advisory Panel, also known as the FAP. The FAP is an advisory group to CARF, and as you can see from the slide here, FAP members include consumer representation and professional representation from life plan communities and the finance and consulting industries. These individuals provide insight and expertise on current trends in senior living. They routinely review CARF's financial planning and management standards making suggestions for alignment with industry standards and banking practices. Next slide. Okay, so now that we have reviewed today's learning objectives and provided some background information on CARF accreditation, let's take a moment here for our first polling question to find out more about those of you participating in today's webinar. So you should see a pop out with the polling question if you're participating today. And I just want to remind everyone who is seeking to qualify for the CPs that you need to respond to all of the 6 polling questions that will be on today's or what that will be throughout today's webinar. So this is the first one, and we're just asking to get an idea of which of the following best describes you. So accountant, actuarial, board member, CEO or president of a life plan community, CFO, COO, a consultant to a life plan community, or perhaps you're an investment banker or finance professional joining us today, or a resident or future resident of a life plan community. Or perhaps this is not an applicable question for you. So while you all are taking a moment to answer this question, let's go to the next slide, please. And I'll turn things over to Tommy Brewer to give us an introduction and to take us on a deeper dive into the senior living financial ratio observations and trends.
Thanks so much, Julia, and it's a pleasure to be here today. My name's Tommy Brewer, and I have the pleasure to work at Ziegler Investment Banking. I'm based out of Richmond, Virginia, work a lot in the Mid-Atlantic region, kind of Pennsylvania down to Georgia. And I, along with Pat, are going to review some senior living observation and trends that come about through the CARF ratio process. So, Steph, if you can advance the slide. To get our bearings on what the ratios and where the ratios came from, we kind of wanted to show the universe of providers of senior living services that range all the way from life plan communities to standalone nursing homes, home health agencies, hospice, all the way down to active adults. We are focused on the life plan communities. This whole endeavor is focused on the 1,911 life plan communities. It's interesting to note that when we show this slide, it always gets my attention that of all the services that are provided within the senior living industry, the only one that remains dominated by the not-for-profit industry are life plan communities. About 74% of the 1,911 communities are not-for-profit. It's also interesting to note that of the 1,911, about 68% or 1,300 of the facilities are a part of a multi-site organization, which means there's more than one under similar governance, and about 600 are single-site organizations. Advance the slide, please, Steph. And if you want to break out the 1,911 throughout the country, you'll see the state breakout. We actually, over the course of the past couple of years, have seen some contraction in the number of life plan communities. For instance, when we showed this graph in 2022, there were 1,944 life plan communities across the country. So we've actually lost some over the course of the past year. We are still actively looking for that for those individuals that are interested in branching out into Wyoming and Alaska, the only 2 states that do not have an existing life plan community. 2 states that I have not been to, so I would love to be associated with that development. So reach out if you have any interest there. But you'll see it's a pretty broad dispersion of communities across the country. There's a high concentration in the Mid-Atlantic and Southeast, and also on the far West Coast. If you can advance, Steph. So in addition to CARF, are the other ratio resources that are available, and there are several different ways that we track ratios, and you have the ability to go out there and find different avenues to do some ratio analysis. One would be if you're a multi-site provider, you have similar operations within your organization. That's obviously a good way to benchmark. You also have the historical information from your own organization. The rating agencies, primarily Fitch Investor Services, they also publish their ratios on an annual basis, and that's a good source of comparison purposes. We have the State of Senior Housing, who provides ratios. If you can advance, Steph. We also fortunately have the Medicare and Medicaid cost reports. Those are a bit more cumbersome to get into, but the data is available there for some ratio analysis. A lot of state associations provide their own detailed ratio analysis for organizations that are within their state. We also are aware of quite a few peer organization groups out there. Some of those are within a state, some of them are, across multiple states, who do a significant amount of work from a peer group surveying perspective. And then we have the professionals that are out there that will publish different ratio and benchmark analysis based on either individual disciplines or different categories. One of the areas that we've seen perhaps the most growth when it comes to benchmarking is not only from a community perspective, but on a level of care benchmarking, where you're comparing independent living operating results to just other independent living communities, assisted living, memory care, and nursing. Obviously, with everything that's going on in skilled nursing today, the ability to isolate operating environment by level of care has perhaps become a higher focus point here more recently than historically. So, Steph, if you can advance, as we have the ability to look at different analysis and different ratios, so what do we do with those? What do we do with the benchmarks? Well, we can create a culture of continuous, quality improvement. We know that ratios and financial results aren't the only measure of quality, but it is one measure of quality. The second thing is, it does tell us a bit of a story, particularly if things have diverged from one year to the next. It won't necessarily identify exactly why, but it will enable us to look to see what is going on in that particular area. It also will help identify, some weaknesses or maybe outliers, and that may have the benefit of finding opportunities that we can become more efficient. It also, can provide a high level of direction for management to identify problems from a start perspective, and hopefully will alleviate them becoming bigger problems in the future. And then, the various dashboard reporting and trend analysis over, multiple periods of time. We'll talk a bit, both Pat and I will talk about, obviously since 2020 and the pandemic, we've seen that be a period of time that is perhaps unique compared to other periods. And it's helped identify, some trends that occurred during that period of time. It's Steph, if you can advance, one of the realities, and this comes up quite a lot, is we know that benchmarking does also present some challenges. It's not a one size fits all analysis tool. We recognize that it is varies dramatically based on geographic location, based on the type of facility. For instance, a type A community versus a type C community has very different approaches to the contract structure, which could have material impact on some of the financial ratios. We also, some organizations have a pretty high debt burden and others don't. That obviously is a key factor when it relates to some of the key benchmarks, and some of the key ratios are tied to debt. Some organizations are stronger in cash and have a lot of debt. Others are weaker in cash but have little debt. It also, from a financial reporting treatment perspective, not every state, locality, and accounting firm treats everything exactly the same. I often, when I go through and do financial analysis, I'm finding myself often trying to recategorize things from one organization to another based on different accounting treatment. So it's important to note that those differences may exist. And it doesn't often tell the qualitative story. Definitely it is effective telling the quantitative, but qualitative, there's a lot that goes into operations that are well beyond numbers. But we do think it is an effective tool and something that can be utilized to help identify issues, hopefully before they become huge issues. So Julie, with that, I'll turn it back to you for the second polling question.
Okay, great. So if we could just advance to the next slide here, we'll go over the second polling question. So those who are seeking those continuing education credits, this is poll number 2 of 6 that you need to respond to. And we are seeking your thoughts on what benchmarks that you rely on or reference, and you can select all that apply. So some of those that Tommy just went over: leading age or state associations, rating agency, proprietary, organizational, state of senior housing, the Medicare or Medicaid cost reports, or CARF financial ratios, or other, or if these are not applicable to you. So take a moment and make your selection there. And while we're doing that, I will just share the results from our first poll, which was asking a little bit about yourselves. So we know that from your responses, a third of you are identifying as an accountant, 1% actuarial, 4% of you are a board member of a life plan community, and 4% of you are a CEO or president of a life plan community. 34% of you, not surprisingly, are a CFO or COO of a life plan community. So that's a good group. And then 5% are consultants to life plan communities. And then we have a 3% joining us today who are falling into that investment banker or finance professional category. 3% resident of a life plan community, and then a good chunk, 15% of you, are in our other category. But thankfully, there was no one who chose not applicable. So we're glad to have you all with us today, and we'll just keep moving along. So if you'll advance to the next slide here, I'll turn it over to Pat. And Pat, would you introduce yourself and start your presentation about the accounting updates?
Great. Thanks, Julia. And good afternoon, everyone, or morning, depending on where you are. And just by a quick introduction, my name's Pat Heavens. I'm an audit partner at Baker Tilly. I work out of our Philadelphia office, and I do sit on the financial advisory panel at CARF. We're going to talk through just an overall accounting update. And, fortunately, another relatively quiet year from an accounting standards standpoint. There's been a lot of accounting standards that had a pretty significant impact to this industry over the last few years, including revenue recognition. There was a not-for-profit standard out there, and now we have the lease accounting standard. There's obviously a whole host of other accounting standards that are always being issued, but those are kind of the big ones that have had an impact. And as we look forward here, nothing really on the horizon that's expected to have a significant impact on the industry. But again, it's a case-by-case basis for each organization to evaluate. So if you want to go to the next slide. We just do have a slide here on lease accounting. This is really the one significant standard left to be adopted by certain organizations. And we've discussed this in prior years on this webinar. And at this point, I think all organizations should have adopted this by the end of this calendar year. And as you likely know, that the main change here is that all lease arrangements will go on the balance sheet, regardless of if they are operating or financing leases. Next slide. So despite it being a pretty quiet year from an accounting standards standpoint, there still has been a lot going on over the last couple of years as it relates to COVID funding that's out there. And this slide really just highlights some of the major sources of funding that organizations have received. And, I think the bottom line is that there's been a lot of funding pushed out from the federal government over the last few years, which has to be considered when evaluating the financial results of an organization. And just want to point out, consistent with last year's or the last couple years publication, important to remind everyone as we talk through these next few slides that there has been significant funding out there to make organizations whole from the losses experienced from the pandemic, but none of that funding is incorporated into any of the ratios that are presented in the publication. And really the reasoning for that is to allow, a true presentation of the impact of the pandemic, coupled with the fact that, there's a whole host of factors from an accounting treatment standpoint and the timing of recognition of the funding that could vary depending on the individual facts and circumstances for each organization. Also important to note that while the income from these grants and any debt incurred is excluded from the ratios, the cash received was not excluded from the ratios where cash is incorporated. So for instance, days cash on hand. So beyond the provider relief fund, the Paycheck Protection Program, you have Medicare Advance and Accelerated Payment Program, which at this point likely has been paid back. There is a FEMA. There's obviously the FEMA program out there for organizations that have sought out those funds and applied for those. And then the other program that has received a lot of attention lately is the Employee Retention Credit, or ERC. And we'll spend a couple minutes in a few slides discussing some of the latest news on the ERC program. Go to the next slide. Just real quickly on CARES relief, provider relief funding. So this has been one of the most significant funding sources the last few years. And I think almost all senior living providers saw some of these funds over the last 2 or 3 years. And they're to be used for healthcare related expenses and lost revenues due to COVID-19. These funds do not need to be repaid to the government as long as the organization complies with the terms and conditions. And then there are 5 reporting submissions that were due, the last one being due here September 30th of 2023. Requirements to keep the funds is to do that reporting, and then also single audits. So many organizations have completed single audits or continuing to complete single audits if you met the applicable thresholds of federal expenditures of $750,000 for a year. So again, a lot of organizations have that ongoing right now or have had those completed. Next slide. Employee retention credit. You've likely heard a lot about this, but just some quick background. The ERC is a refundable tax credit for businesses and tax exempt organizations that had employees and were affected by COVID-19. The requirements are different depending on the period that's being applied for, and the credit is available to eligible employers that paid qualified wages to some or all employees after March 12th, 2020 and before January 1st, 2022. Generally speaking, there's a couple different paths of determining eligibility and demonstrating that. One being a decline in gross receipts, and then another demonstrating that your business was shut down by a government order. And really, at the end of the day, from an audit and financial reporting standpoint, it all comes down to that eligibility determination. So that is really critical for organizations. Important that you have all the information there buttoned up and are confident in your eligibility write-ups and calculations, especially given some of the increased scrutiny that we are continuing to see surrounding this program. And you see some of that listed here on the slides. The IRS has stopped processing new claims through the end of the calendar year here. They're working with the Justice Department, in their words, to address fraud in the ERC program, as well as promoters who have been ignoring the rules and pushing businesses to apply. And again, just the bottom line here is the IRS is going to continue to process these claims, but likely will be at a slower pace and with increased scrutiny. So again, eligibility is important and critical. Every organization's, documentation on that is likely case by case, but just something to keep in mind if you've applied for the employee retention credit or filed for it or anticipate doing that. And, I think there's certainly more to come as it relates to this program. So certainly stay tuned as more information is available. To close out the COVID funding, in summary, we've had a lot of significant funding to senior living organizations over the last couple of years. And, just finally, to remind everyone again, the income or debt from these funds is excluded from the ratios in the publication. And just important to point that out because that likely is not the case for how an organization does maybe their debt covenant reporting or internal reporting. So there may be some differences in some of the CARF numbers here compared to what an organization is doing and reporting internally or with their debt arrangements. If you want to go to the next slide here, just a couple quick other accounting considerations that are kind of hot topics right now and of more focus. Going concern is something that is required to be evaluated by management as part of preparing their financial statements, and that goes across the preparation of all financial statements, right? And really, management should be evaluating if there are conditions or events that, when considered in the aggregate, raise substantial doubt about the organization's ability to continue as a going concern within 1 year after the date the financials are issued or available to be issued. And this evaluation is critical for any organizations experiencing declining operations or liquidity that's declining. More specifically, as we kind of move past some of the federal funding from the pandemic that's been out there, that starts to slow down. Certainly, more organizations are going to have to continue to pay close attention to their going concern assessment. A key part to that assessment is monitoring debt covenants. That includes not just in the current fiscal year, but beyond. So it is a forward-looking projection. So, you're assessing your ability to continue as a going concern 1 year out from the date the financials are issued or available to be issued. So debt covenants, not just being compliant with your debt covenants within the current year is part of that, but also, projecting those out, assessing, the ability of, what would constitute events of default, the ability to repay debt. Should there be an event of default, meeting other obligations as they come through are all critical as part of this evaluation. If it is determined that substantial doubt is raised and that's either alleviated or not alleviated, there are certain disclosures considerations, including management's plans as part of that if you are in that situation. I'm going to go to the next slide. We have a couple slides here just on impairment considerations and similar, along the lines to going concern. This is just another point of emphasis that many organizations right now are having as they face, history of operating losses or other potential operating declines. This slide kind of lists out the multi-step approach to impairment testing of PP&E. And if I'm going to go to the next slide, this shows some examples of events or circumstances that may indicate that the carrying value of an asset may not be recoverable. Most commonly, that first bullet there, which is a history of recurring operating losses or cash flow losses. And then, in addition, a projection or a forecast is likely a component of that assessment. So, taking your projected future cash flows and comparing those to the carrying value of your property equipment is kind of the first step typically in performing the assessment of impairment. So again, that along with going concern is something we're likely having to think about more than we might have in the past for a lot of financial statements that are being prepared. Then if you want to go to the next slide. So next we'll get into some of the actual ratios from the publication, and as I think we've talked some about here, there are three main types of ratios or categories in the publication. And as we'll talk about some of the challenges that are experienced, specifically as it relates to the profitability ratios. The struggles with profitability ratios reflect, some of the challenges in the non-operating income specifically. And we've seen some single site improvement in core operations while multi-site, profitability medians have continued really to decline. Liquidity ratios, the story here has been, positive in recent years. We've really had very strong and increasing liquidity ratios, generally speaking, over the last couple of years. But looking at 2022, there were declines in the markets, and as a result, many of these ratios were weakened. But important to keep in mind as well, they still have remained at relatively healthy levels. And then finally, we'll look at the capital structure ratios, which generally speaking have shown a weakening trend, which is a reflection of some of the overall weaknesses seen in the profitability and liquidity ratios. I want to turn it over to the next slide. I think we have a poll, so I'll let Julia jump in.
Okay, great. Thank you, Pat. So for those of you following along and answering these polling questions for your CPEs, we're halfway through. This is polling question number 3 of the 6 you'll need to respond to. We're wondering, has your community filed for the employee retention credit? So this is a yes or no, or perhaps a not applicable. And Pat, I'm just going to cue you into the fact that we did have a couple questions about the ERC in the chat. So if you'll just take a look at those real quick and decide if you want to respond to those now or perhaps later in the Q&A. And I'll just quickly share the results from our last polling question, which was about benchmarks and what do people rely on or reference. And so what we've learned is from our folks who are joining us today, 17% of you are looking at the leading age in the state associations. 16%, so about the same amount, are looking at rating agency benchmarks. Then about 15% of you say that you're also referencing proprietary benchmarks. 7% are looking kind of internally, organizationally, maybe across that multi-site provider option. 6% of you are mentioning the state of senior housing, 9% referencing Medicare and Medicaid cost reports. Nice to hear 23% of you look at the CARF ratios. 5% of you responded other, and then we did have a small 2% that the question just wasn't applicable to them. So I will turn things back over to Pat and we can kind of continue on with the presentation of the ratios here. Thanks.
Great. Thanks, Julia. And I'll certainly take a spin through the Q&A here before we wrap up, and we'll address some of that on the back end as time allows. And certainly, again, if anything we don't get to, we'll be sure to respond to offline. So next, we'll talk through some of the ratios, specifically first the profitability ratios. So there's 5 main ratios that we're going to cover here, and really critical to understand these ratios as part of understanding the revenues and expenses for delivering of an organization's services and how reliant an organization may be, not just on their resident-based income, but also non-resident-based income. So for instance, contributions, investment income, things like that. If you want to go to the next slide, we'll look first at the net operating margin ratio. This ratio measures the core profitability of an organization focused solely on resident-based revenues. It's calculated by taking resident revenues less resident expenses, and then dividing that by resident revenue. The NOM excludes entrance fees, while the NOM A, which we'll look at on the next slide when we get there, it includes the entrance fees. So also important to point out that the NOM excludes contributions and net assets released from restriction, even though, for many organizations, they do consider these income sources as part of their core operations, specifically and within their financial statements. And the findings during this year's publication showed overall declines in this ratio. In 2022, the median NOM did improve for single sites from negative 0.29% to 1.98%. Also improving at the top and bottom quartiles, and then the median NOM for multi-sites did decline to 0.44% from 1.05, which is the lowest that we've seen in some time there. So obviously a large part of what's driving the NOM and operations, no surprise, is occupancy. So as occupancy goes, some of these other ratios go as well. If you want to flip to the next slide, which is the NOM adjusted, which actually saw some improvement on the single and multi-site side, which I think can likely be attributed to improvements in some of the independent living occupancy, which is, I think, overall a general trend we've seen in recent years post-pandemic. Specifically, the independent living occupancy has done a nice job of bouncing back and being relatively healthy. There's good demand out there for independent living, within the senior living space. So again, this ratio includes entrance fee proceeds in the calculation. So it's otherwise the same calculation as the NOM. So if you compare the NOM A to the NOM, it really highlights maybe the importance of an organization's cash flows from entrance fees, and how maybe reliant they are on those as part of their operations. It improved for both single and multi-site providers, went up to 19.5% for single sites and multi-site rose to 18.27% from the prior year. Next slide. Next up's the operating ratio. So this is actually one of the ratios where the lower the ratio, the better. And this measures the ability of operating cash revenues to cover operating cash expenses. So for each dollar of revenue generated, how much is an organization spending on that dollar? And again, this is focused on cash revenues, similar to how the NOM ratios are focused. A ratio under 1, generally speaking, is desirable. However, there are many organizations that will typically have this ratio above a 1 if they're more reliant on significant entrance fees. As you can see here, the single site median held steady at 101.46%. And then the multi-site provider median, weakened or increased to 105.13%. Which is just above the weakest level it's been. Again, a lot of factors that go into this. Certainly rising costs and inflation and things like that play a role. And then, as we talked about, occupancy is a key component on the revenue side. We'll flip to the next slide, which is the operating margin ratio, which this measures the portion of total operating revenues remaining after operating expenses are met. And this is calculated as income from operations divided by total operating revenues. Contributions and realized investment gains or losses are excluded from this, even though many organizations include those in their operating gain and loss results within their financial statements. It does include non-cash items of depreciation and amortization of entrance fees. Therefore, this ratio sometimes is considered one of the primary indicators, along with the total excess margin, which we'll talk about in a little bit. But yeah, really one of the primary indicators for providers, in demonstrating their ability to generate surpluses for future needs. And then, as you can see, this is the fourth or fifth year here that this ratio has once again, been negative. And despite some of the recent decline, the median, did improve for both provider types this past year to negative 4.17% for single site and rose up to negative 3.51% for multi-site. So, again, still negative, but did see some improvement this year. Next, the last profitability ratio that we have on the next slide is total excess margin. I'll flip over. There we go. This measures bottom line profitability and is similar to the operating margin. However, it also includes non-operating sources of revenue. So as a reminder, this, along with all profitability ratios, excludes unrealized gains and losses on investments. But again, other investment gains, realized interest and dividends would be included. A value over zero is ultimately essential for organization to achieve positive net assets and provide contingency for unforeseen financial need. As you can see here on the graph, it did weaken significantly for both provider types, which reverse some of the turnaround that we saw last year. Big component of this, again, is likely some of the investment markets and some of the, not having some of the significant gains, realized gains that organizations achieved over the last couple of years. So you can see that the single site median fell to negative 2% and 2.16% for multi-site. So moving on to the liquidity ratios. If you want to go to the next slide, is the days cash on hand. And, for liquidity ratios, days cash on hand is really the chief measure of liquidity. As you can see, we've seen some, historically high levels here in recent years. And in 2022, we saw some of these ratios weaken some. Entrance fee, proceeds, investment performance can have a significant impact. So, overall, I think, some of the entrance fee activity, the general theme there has been that has improved. So, taking from that most of this decline is market driven. And And this is calculated as unrestricted and investments over daily operating cashes. So basically, it's the how many days of cash expense are you able to cover as an organization with your unrestricted cash and investments. So the single site median fell to 419 days from 547 days last year, and the multi-site median weakened to 308 days from the 352 that it was at last year. So again, in summary, we've seen declines, but really historic levels in recent years, and these days cash on hand, medians are still at a very healthy level overall. Then finally, the next slide is the cushion ratio. This is the last liquidity ratio that we'll cover. Flip over to that next. There we go. This measures the provider's cash position in relation to its annual debt obligation, uses annual debt service as the denominator, and the numerator is unrestricted cash and investments, both current and non-current. This decline for single site providers falling to 10.54, which still is healthy compared to some of the medians going back, pre 2019, 2020. And then for multi-site providers, it dropped to 5.31%. So that is, pretty close to the lowest level, kind of right there with where it was in 1996. So, again, some declines this year, which I think is to be expected, some given, where we saw the days cash on hand medians move. Look to the next slide. I think we do have our fourth polling question, so I'll hand it back to Julia.
Okay, great. Thank you, Pat. All right, so we're on to polling question number 4. Those of you keeping track, this is 4 out of 6 that you need to answer in order to get those credits for today's webinar. And the question that we have for you is, what changes in nursing agency usage have you seen over the last 12 months? So your answers may be, we're continuing to use a high level of nurse agency, or the agency usage has improved but is still at a higher than normal level. Perhaps agency usage has improved to more normal levels, or there's been no change in nurse agency usage over the last 12 months. You could also not use any nurse agency, or this question may not be applicable to you. So take a moment to answer. And you may recall our last polling question was about the employee retention credit and who had filed for that. So I'll just share the results of that quickly with you. 36% of our participants on today's webinar have filed for the ERC. 32% responded that no, they have not filed for the ERC. And then 32% said that that was not a question that was applicable to them. So just wanted to share those responses, and folks can continue to kind of take a moment here to answer the polling question for number 4, but we're going to go ahead and go to the next slide and can kind of continue on here with our presentation. And I believe I'm passing this back over to Tommy to cover capital structure ratios.
Thanks so much, Julia. And that's an interesting poll response on the ERC. That sounds like about 50% of the folks on the call that are eligible have taken that, and 50% have not pursued. So Pat, I know we're going to talk a little bit about that towards the end of the presentation. That's certainly one of the programs as we went through, the COVID process that we struggled to get governmental funding in a lot of areas, and that's one that that's still out there that we should still pursue. When we look at turning our attention back to the financial ratios, what I find very interesting looking at these ratios is the dynamic that exists between the single site organization and the multi-site. And perhaps none of them can be measured as dramatically as the unrestricted cash and investments of long-term debt. You'll see here, this is a graph going back to 1996, which compares your unrestricted cash and investments. So that includes everything that could be used in a distressed situation compared to your long-term debt. And Interestingly, single sites back in 2021, last year, we hit our highest level of cash to debt in history, which was odd coming off of the pandemic, but a lot of that has to do with the stimulus programs that I just referenced. Not inconsistent with some of the operating ratios that and liquidity ratios that Pat described. We've seen a dramatic drop off in that here over the past year. That is almost exclusively related to the numerator of the ratio. That is, we've seen a decrease in our cash position, both from market returns as well as operating challenges. So from a significant decline now, not only are we off the all-time highs, but from a multi-site perspective, we're almost at the all-time low. We got there in 2008 as well, but that ratio is being challenged a bit, and it's one that the capital markets arena looks at very closely. If you can, Steph, advance the next ratio, which is perhaps the most common ratio that is referenced for financial health within a CCRC, certainly on the debt side of things, is the debt service coverage ratio. And the debt service coverage ratio is a ratio that analyzes the income that's available for debt service, so free cash flow that is generated on an annual basis, and that cash flow has come from all different operating entities, as well as contributions, as well as investment income, and it compares it to either your max annual debt service, which is the maximum debt service you'll have in any year going forward. That's the max annual debt service ratio. This is the annual debt service ratio, which compares it to your annual debt service in that year. So again, it's the free cash flow that's generated in a year compared to your debt service requirement in a year. We've seen tremendous consistency in this ratio between single sites and multi-sites, which is interesting. And we have seen a drop in 2022 compared to previous periods. That drop, again, is consistent with the decreased operating performance and investment return performance that Pat articulated. One of the perhaps key, in addition to the debt service coverage ratio, what has become almost more important from a lot of investors' perspective is the debt service coverage ratio revenue only. So Steph, if you can flip to the next page, you'll see that this ratio is almost identical to the debt service coverage ratio, but while the debt service coverage ratio numerator does include entry fee turnover, in the numerator, revenue only takes that out. So it measures what your performance is strictly from monthly service fees and other revenue generating opportunities, and not from entry fee turnover. You'll hear a lot an aspirational goal for organizations to be at a one-time debt service coverage ratio revenue only. That would mean that you're able to cover your debt service if you had zero turnovers in a year at least one times, which is certainly a notable achievement if you can get there. We've seen over time that we have been at that number or above. Unfortunately, here more recently, we have dipped below for both multi-sites and single sites to significantly below that one-time level. It's something that I think is not surprising given the operational challenges and the operating results, operating margin, which Pat described, but it's something that is getting an increased attention from the investor community. You know, we often get questions when you look at, and you can flip to the next page, Steph, about, okay, when we look at ratio analysis, you know, are there aspirational goals that we should achieve? And perhaps one of the ways we can look at that in concert with the CARF ratio is by looking at the rating agency medians. By looking at the rating agency medians, there are about 10% of organizations throughout the country that have achieved an investment grade rating or better, which means that they would be analyzed in the category of the strongest in the industry. And sometimes folks use that as an aspirational goal that we want to get to a BBB rating at some point in time, or an A category rating. So that's something that I would point people to look at, not only the CARF ratios, but also the Fitch Fitch ratios. I think it would be beneficial to look at those in concert. What this slide intends to do is show how the rating agency views the credit climate and what things are happening. You'll see the middle there is the year that we're representing, and the check marks above the year represent organizations that have improved their rating category within the year. And the check marks below are organizations that have had their rating category decline. For instance, if you went from triple B to triple B plus, you would be a check above the year. If you went from triple B to triple B minus, you would be a check below the year. You'll notice 2020 COVID comes, you'll see a significant number of downgrades versus the only one upgrade. We saw a little bit of normalization in 2021 and 2022. 23, we don't have a lot of data there. There have been 4 downgrades and 1 upgrade. But generally, Fitch has taken through the pandemic, has had significantly more downgrades than they've had upgrades. Some of that has to do with the next slide. You can move forward, Steph, and that is, where's the interest rate market been over the past several years, and then here more recently. I think in a lot of areas we don't want to go back to 2020 in the pandemic, but if we could flip it and reverse it back to 2020 from an interest rate perspective, that would be advantageous. You saw that we had a tremendous decrease in interest rates at the start of the pandemic all the way through the end of 2021. Now we've seen a dramatic increase over the course of the past several years, and this has made its way into a lot of the ratios that we just articulated. Some organizations have their capital tied into interest rates that reset on a monthly basis. Because of that, with a dramatic increase in interest rates over the past several months and year, we've seen their cost of capital go up, which has had an adverse effect to operating performance. You'll see in the graph, this is for a triple B rated organization, so it's a little bit above the standard credit quality of the 1,911 life plan communities, but we think it's a good proxy. You'll see currently we're at about 6.13% for the 30-year maturity. The 10-year average before this year was 4.23%, which was historically low, probably the lowest 10-year period in history. The 1990 to the year to date is 5.79. So we've actually now crept above the 25-year average for the first time in a while. And that's having some impact on some of our credits that have that variable rate debt. Wrapping up with a couple of the last ratios, Steph, if you can advance. Average age of community is a ratio that I don't know we spent as much time on historically as perhaps we should have. You can advance to the next slide, Steph. Sorry about that. What this measures is how are you reinvesting in your community as compared to the depreciation that is incurring at your community. Low is good. So if you have a low average age of plant, that means you are investing in it through capital expenditures at a rate that is at or above what your depreciation expense is. You'll see since 2000, we've had consistently increasing line, which means our communities are getting older across the country. We're not investing as much in our communities as the organizations are depreciating. We have seen a bit of improvement in the past year, which is a good sign. It's the first time it's gone down in a couple of years, but it's still significantly higher than it was in the early 2000s. And part of that, the corollary ratio to the average age of community is flipping forward, Steph, to the next page, is capital expenditures as a percent of depreciation. This is how much are you spending on an annual basis compared to your depreciation expense. And something above 100 means that you're spending more on capital expenditures than you have in depreciation expense. And for the most part, we've been somewhat successful in that over the course of the past several years. It's dipped significantly in 2021. While a lot of times we don't know exactly why these ratios change, we suspect a lot of the stimulus programs that folks received in 2021 as well as the needed changes to physical plant that COVID brought, caused us to spend significantly on physical plant during the COVID 2020 and 2021 periods. And now that we're past that, we've dipped back down, but both are still 100%, which I think would be viewed as favorable and positive. We often get asked the question, Steph, you can flip to the next page, about when we issue debt for new communities, where are those proceeds being spent? And I think this is an important analysis because it goes into, and you can draw some conclusions about this. For instance, when 85 and 86% of all new money issuance are in independent living reinvestments and expansion, that could be viewed as an accretive debt issuance, which means that we're hoping the new independent living units are going to add revenue streams to the organization. And however, for common area upgrades and skilled nursing repositionings, those are often non-revenue producing, which have adverse effects to our financial profile. That's reinvesting in the community without any immediate revenue jump to that. We have seen a sharp decline in the skilled nursing repositionings. It was very common 5 or 6 years ago for folks to repurpose their nursing facility from an institutional style to a neighborhood style. So there was a lot of that was episodic that happened in the, kind of the mid 2015, 2016 time period where folks were reinvesting in nursing. That's obviously a very hot topic right now, and we've seen a significant drop in that. But it's interesting to know where the proceeds have been spent. With that, Julie, I'll turn it over to you for the 5th polling question.
Okay, great. Thank you, Tommy. Appreciate that. So we're next to the last polling question here for those keeping track. Our question is, has the volatility in investment portfolios prompted your organization to change your asset allocation to, and you can choose one of these areas, greater equity allocation, greater fixed income allocation, or greater cash allocation, or no change at all, or not applicable? And while you're making your selection here for our 5th polling question, let me just share what we learned from question number 4, which was about nursing agency usage the last 12 months. So I'm going to start kind of with our last answer there. So 25% of you said that's not applicable. 13% of you said we do not use any nurse agency. So then we had some folks who said there's been no change. Less than 1% said there's been no change over the last 12 months. 15% of you share agency usage has improved to more normal levels. 3% of you said you're sort of at a normal level here at this stage. 31% are sharing that agency usage has improved, but is still at a higher than normal rate. And then 12% report that you're continuing to use a high level of nurse agency. So that's interesting poll. Thank you for taking the time to respond to that. I will say we've had some questions coming in throughout the presentation today. We're looking at those. We're going to try and address those either during our presentation or we'll get to those during the Q&A. If we're not able to, we will follow up with you individually. So just know that we're monitoring those and keep sending them in. So we'll go to the next slide. And at this point, I'd like to turn things over to Ann O'Malley to introduce herself and to provide our presentation for today.
Okay, thank you, Julia. Hi, my name's Ann O'Malley, and I'm the Chief Financial Officer for Kendall at Oberlin and Kendall Northern Ohio. I have been with Kendall for over 22 years and have actually been a CARF virtual finance surveyor for 20 plus years. The one thing that I have learned over my career is improvement in financial performance takes focus and persistence over a period of time. It never happens overnight, but it can happen if it's measured and tied back to your organization's strategic plan, your long-term financial goals, and especially operational initiatives. Next slide, please. Let me share a little bit about Kendall at Oberlin. Kendall at Oberlin is celebrating its 30th year anniversary since opening in 1993. We are predominantly a Type A community with 225 independent living units, 55 assisted living suites, a memory care neighborhood, and 12 private skilled nursing rooms on a campus of over 110 acres that is a level 2 arboretum. Kendall at Oberlin has annual revenues of approximately $24 million with total assets of $120 million. We are an A+ rated community with a stable outlook that was given to us by the Fitch Rating Agency. Next slide, please. What I'd like to share with you is how Kendall utilizes benchmarks and ratios as part of really our normal, ongoing operating practices. Some of the ways we use it is to really provide a baseline of where we stand and trend analysis. For instance, it can be used when working with your leadership team and your organization's budgeting process. We're also able to compare against other communities from an operational and financial perspective. And this is a great way to determine where you stand as it relates to other like communities. It's very helpful with board education or communication with some of your other key stakeholders. They can also be very helpful with establishing financial goals for your organization, such as your long-range financial plan. Cannot stress enough the importance of evaluating the different strategic initiatives before you implement them and the impact they could have on your ratios and your overall overarching financial goals. It can also be used as a communication tool for your key stakeholders, board, residents, staff, and outside agencies. We've utilized the ratios as a way to communicate Kendall's financial strengths with our key stakeholders, even with our priority list members, which are our prospective residents. Next slide, please. Some of the ways we share the financial ratios with our key stakeholders have included, we've developed a dashboard for our finance committee that has been used to provide them with, number one, a snapshot of where we stand, but also provides a good trend analysis related to the financial health of our organization. We also can use it with our management team to educate them on where we stand on both financial level, but also operationally. With residents, when we provide financial updates, especially when we do our annual disclosure statement presentation, we've used them to do comparisons with other Kendall affiliates and peers in senior living. The CARF ratios have been developed with a consistent way to calculate the ratios, so they are truly comparable, which I know really is something that is very important because you can get into the weeds, but the one thing CARF does really well is it is very consistent in how the definitions are applied, and it makes it very easy to compare how you're doing. We utilize the ratios with other key stakeholders such as CARF, with our rating agency, our lenders, and even with our priority list members. The next few slides were taken from a variety of presentations that were shared with some of these various key stakeholders. So I thought I'd share with you some of the ways we've used them. Next slide, please. So this slide really depicts a slide we used for board orientation on what's important to look for in a life plan community's financial model. And it's a way to educate the board as they're coming on to the board in different committees and such of what are the key indicators that you should be looking at. And of course, these look very familiar, correct? They're the profitability ratios, liquidity ratios, and capital structure ratios, which we just covered. But again, we use this in board orientation, and it's a great way to kind of give them level setted on our financial model. Next slide, please. This slide was used for board education when we were evaluating a strategic initiative. And we were looking at this to be sure we had the financial strength that would be needed in order for us to implement that initiative. We used it to compare against the CARF median ratios, which again gave them information about, it helped to inform them of how we were doing compared with the CARF median, but then also how we would do if we were to implement this strategy. Next slide, please. This particular slide was shared with our Audit and Compliance Committee at the annual meeting with our external auditors. This came from our external auditors utilized the CARF ratios as a way to benchmark our performance against. And I know that our board and the Finance Committee and Audit Committee all love these kind of information because it really is informative for them of where we stand and how we're doing compared with others. Next slide, please. This one provides you with, this actually was a slide I used with our residents at our annual disclosure statement presentation. And it really is a way to educate them on how important it is to build reserves and especially liquidity in order to be able to act strategically. You know, sometimes residents will be concerned about, do we have too much in reserve? And my contention is that in order for us to be able to act strategically, we have to have that reserve in order to weather all these volatile times. So this is another way to show with them what happens if you don't, and that you can't really, you're barely treading water if you don't have enough liquidity. Next slide. This technique, which I would call it the generative discussion technique, was used with at a board retreat. We shared a number of slides prior to that that included Kendall's financial ratios and that really overall showed a measure of our financial health. And then we utilized the generative discussion technique to really actually support a particular discussion that the board was focused on. But it was really looking at, where we stood financially, and then near term, what does Kendall need to do to focus on to strengthen the overall financial position? Longer term, how will we continue to remain viable in the senior living industry? And then finally, what will the state of the senior living industry look like in the future? And will we be ready? And again, we use the generative discussion as a way to prompt the board into some of a deeper dive, but then we pepper it with the financial information ahead of time so that they really can feel comfortable about addressing some of these more meaty questions. And again, that was done at a board retreat. Next slide, please. So in closing, I'd like to stress the value add that we obtain from being an accredited community. It's really the good housekeeping seal of approval from a consumer perspective. In fact, we've had residents tell us that if we weren't accredited, they would not have moved into our community. Access to CARF's financial ratios, database, and trends information is extremely important to being able to measure your own organization's financial health. As we have seen, it can be used as an educational and communication tool with many of our key stakeholders. It supports our long-term financial planning. In fact, last year we were finalizing our strategic plan and the long-range plan that supports that. And the initial time frame of our master plan needed to be revised to extend it out over a longer period of time in order to support a fiscally sound plan. We used the ratios to help us determine the timing that would be most beneficial for our organization. Being part of a CARF accreditation process allows you to interact with other peers from across the country. CARF has a consultative approach to the survey process and is more focused on process improvement versus a gotcha approach. I'd like to highly recommend that you consider becoming a CARF virtual financial surveyor. You really get so much more out of it being involved with other communities across the country. I get much more out of it as being part of the virtual financial survey process. Next slide. So if you're interested in if you're interested in wanting to learn more about becoming a surveyor, please visit CARF's website, and it's listed there on the slide for more information. I'd have to say it's really a privilege to be part of the CARF team, and really I would take this to heart in looking at this as really a great development opportunity overall. Julia, I'm going to turn it over to you.
Okay, well, thank you, Anne. Really appreciate that and value your insight as a finance surveyor yourself. And I would just say to folks, I believe are going to drop this link in the chat. And for those of you, particularly those who are the CFO, and if this is something that you are interested in, I think the website is a great resource, but frankly, so are our finance surveyors. So if you have a survey coming up, or you want to talk to Anne about that opportunity, I mean, they can really tell you what that experience is like and what that's about. So if we switch to the next slide here, we'll have our last and final polling question for today. So we are interested in hearing a little bit more about what plans you all have for growth and priorities in the coming year. So, what best describes your organization's plans? Is it a independent living expansion or assisted living, personal care or memory care expansion? Are you doing some skilled nursing repositioning or working on some common area improvements? Or perhaps you're going to pursue an acquisition or affiliation? Or maybe right now you've just got to limit your plans to critical capital spend, or perhaps this is not applicable, but just take a moment here and make your selection, and I will share with you the results from our last polling question, which you'll remember was about the volatility in the investment portfolios and how folks have had to change their approach to asset allocation. And so what I'll share is that 4% of you said that you're doing greater equity allocation at this time. 10% of you are putting greater emphasis on your fixed income allocation. 14% said greater cash allocation. 49% of you, so really the majority, I guess, are saying there's been no change. You're holding steady. 23% responded not applicable. So thanks for taking the time to respond to that poll, and very interesting responses there. And we'll share the results from poll number 6 in a few minutes. But if we can just go to the next slide, please, we will begin to open things up for questions and answers. And so some of you may have been holding on to those questions, but a few of you have already kind of started to post those. If you have a question, please put that in the Q&A box, and we'll look forward to addressing that. And if we're not able to get to it with the timing today, then we will reach out to you individually with a response to your question. I'd like to just start with a general question here for our 3 presenters, and any of you can respond, but it's, what are the most significant challenges that are facing organizations in this current environment? And maybe Anne or
Sure.
Pat, we can start with you. I don't know.
Okay.
Yeah.
I'd be happy to take a stab at that. I think from a provider's perspective, it boils down to really 3 things. Overall uncertainty is really a huge challenge to be navigating through all of this uncertainty we've experienced over the last several years. Inflation is another headwind that we struggle with, and workforce. Pat, I'll let you add on to that.
Yeah, I would definitely echo everything you had said there, Ann. I mean, staffing, workforce is definitely one of the biggest pain points we hear from our clients. I think in certain pockets it's maybe alleviated a little bit, but it's still an issue that many organizations are facing and dealing with every day. So definitely the staffing, and I think big picture we're hearing and seeing a lot of organizations talk more about strategy and whether that's affiliations or right sizing their campus and unit complement, things like that. Just as a result of all the challenges that are out there, a lot of strategic discussions are being had, and I think I touched on a little bit as well in some of my earlier remarks on going concern, but debt covenants, and just maintaining compliance with those for, again, not for all organizations, but for certain organizations has certainly more of a focus when it hasn't been, and maybe ever, or for a number of years. So those are kind of the main things I would point to. Not sure, Tommy, if there's anything you want to add or not.
Just wanted to add on, Pat, to your comment, and you mentioned as well the workforce challenges. We did a survey recently about what are the biggest challenges, and workforce was the number one by far. Just about everybody put that. We know how challenging that is, but what the workforce challenges are causing is, especially in healthcare and in nursing, it's causing the cost to go up so much more rapidly than the reimbursements going up. We just can't keep up. So what used to be either a break even or a slight loss in a nursing facility is now turning into a very big and material loss in nursing, which is causing a lot of organizations to get very creative in what their long-term view is on the nursing complement on their campus. And there are just some very creative, thoughtful discussions going on there that are resulting in some pretty material, significant changes that I don't think any of us would have predicted, a couple of years ago. So, in addition, I would add, Jay, you touched on the complement of units, and that's being looked at very stringently right now.
Okay, well, thank you. Let me just quickly share the responses that we've received from polling question number 6, and then we will go back to our Q&A. But that question was about, the planned growth or priorities for the coming year. And 25% of our respondents on today's call said that independent living expansion is in their plans. 7% are looking at assisted living, personal care, or memory care expansion. 8% are looking at skilled nursing repositioning. 13% are looking at those improvements to common areas. 11% reporting that they're looking or pursuing acquisitions or affiliations. And 9% said, really at this time, they're limited to looking at critical spend or critical capital spend, 27%, did say this is not applicable to us. So that's the results from our 6th and final poll. We still have a lot of great questions coming in. I'm going to take a look at those, but the next one that I'm going to ask for one of our presenters to respond to is, how have you used CARF ratios differently as a result of the financial challenges in today's market?
I'll take that as a first step.
Okay.
I would say, one of the issues we talked about already is the increase in the cost of the workforce has put really significant pressure on operational measures. The ratios are themselves very helpful in quantifying the impact of that situation and creating a sense of urgency to operate differently, either through process improvement or technology. I also like to challenge our team about let's right size our staff. If we were able to operate under these certain circumstances at a lower level, then maybe through process improvement and technology enhancements, that can be our new normal, and not think that we have to go back to pre-pandemic staffing levels.
Okay, thank you, Anne. Anyone else want to address that or speak to that one? Okay, so we've got plenty of questions coming in, but I just want to address one of the more common ones, which seems to be about getting a copy of the Ratio Trends publication that we've been talking about and presenting today. So I want to just share that those who have registered for today's webinar will receive in their follow-up from the call today, you'll receive a link that will allow you to request a download, a PDF download of the publication. So if you've not already accessed that, don't worry. In the follow-up from the webinar today, you'll be able to get that, and you'll be able to access that, the publication through that link. Okay, so just scrolling through here, and I do see that we had a question, Pat, that I think maybe you can help us address. And it was related to the days cash on hand and just kind of asking kind of what was happening with that particular ratio. So what caused the increase in the days cash on hand during the recent years, which is now reversing? Is that something that you want to comment on?
Yeah, sure. Certainly, Julia. I mean, I think big picture, going back before, some of the median ratios we have in this year's publication, you had those historically high levels. And I think the question's asking what really drove that. And, obviously a host of factors, but I think most significantly, strong equity markets and investment returns played a significant role there. Low borrowing costs could have also played some role, in organizations having the ability to, stockpile some cash and have higher liquidity levels at that point. Certainly the COVID funding, some, significant amounts from PPP funds and, provider relief, I think helped a lot of organizations kind of weather that storm. So they didn't really have to dip into any of those reserves, even though operations had been impacted as a result of the pandemic. So again, I think equity markets, investment returns, is probably the biggest factor in that, and we've seen that now kind of reverse itself. But those items were probably the biggest contributors for sure to that trend that we had seen.
Okay, thank you. We did have another question that came in, and this one relates to EBITDA. I don't know if I'm going to be saying that right, but basically our EBITDA or EBITDA based ratios considered to be meaningful measures of operations. And Tommy, I'm wondering if that's something that you would be willing to try to discuss with us.
Sure. The EBITDA ratio is certainly a very common and known measure of operating and financial performance across really all industries, and it's the basis for a lot of the ratios that Pat and I reviewed during the discussion. And I've always equated in the not-for-profit senior living world, kind of the income available for debt service to be very similar, if not identical, to the EBITDA ratio. And that is such a key ratio tool. We use that in a lot of the operating ratios, but also in the debt service coverage ratio. So it's not, it may not be called EBITDA in our world, but that same theory of, and again, for lack of a better word, income available for debt services is what I think our analogy is to that particular ratio. And it is, I think, a great measure, and something when we do a lot of ratio analysis, we try to isolate that number and compare it, across campuses. So I think it's valuable. So yes is the answer.
Okay, great. Thank you. We did have a question about when can we expect the 2023 CARF report, and that is the report that I was referencing in the follow-up materials from today. You would get a link to access the 2023. You can request to download that, and yes, the 2023 report is based on fiscal year end 2022 data. And that is addressed in the report itself. So hopefully we're answering your question about that. We did have another question come in that is specific to the state of Pennsylvania. And I don't know, Pat, being located there in PA, if this is something that you would want to ask or try to tackle, but it was what factors cause Pennsylvania to lead the country in the number of life plan communities? Is that something you could address, or other of our presenters?
Yeah, I'm not sure if Tommy knows some of the answers more specifically on that. I mean, I think that's kind of been the history and the trend that Pennsylvania has one of the highest populations. Why that is, I think, again, just goes back to, kind of some of the startup of some of the CCRCs within Pennsylvania. Obviously regulations play a role in that as well. But Tommy, I don't know if there's anything.
Again, there's no absolute, I think, right or wrong answer here, but it's been interesting to note that, and it's kind of known industry wide. The Pennsylvania, and particularly, I would say Lancaster County, Pennsylvania, is one that it's kind of where the birthplace of the life plan communities, CCRC concept, in some ways kind of started. And I think a lot of folks I have heard believe that that's because of the affinity groups that are popular in that area. That became a very desirable way to handle the aging population. That in different areas of the country, it's not as common for someone to send a parent or a grandparent to a continuing care retirement community. They would view that as their responsibility to keep them in their home or something like that. But it became, a great avenue, an accepted avenue in Middle Pennsylvania, to the extent that we often have to isolate that area and take it out of some of our demographic statistics, because the penetration rate in those areas is so high compared to the rest of the country. The amount of qualifying seniors in Lancaster County that move to a continuing care retirement community is astronomically higher than just about anywhere else in the country. And I think it's because that has become the accepted way to take care of the aging population.
Okay. Thank you. Thanks, Pat and Tommy, for that. So we are almost out of time. And I just want to thank everyone who participated today. We do have a few questions that are still coming in. So what we will do is we will follow up with you all individually to make sure that you get an answer or a response to your question. If we could just go to the last slide here, which is our disclosure slide as we're wrapping things up. Just want to thank each of our presenters for today's call and discussion. And I'll just also note that in the follow-up today, like I said, you'll get the link to the publication. So folks, hopefully, if you hadn't had a chance to look at that before our discussion today, many of these questions that you